Hello and welcome everyone to another weekly update of the margin account. This past week was quite bearish and our overall position is down 2.90% in terms of the all-time return. So in this video, I will go over where the position stands as of the end of week on July 17th. I will also share my plans for the next set of purchases that I'm planning over the next couple of months. This is how the position stands as of July 17th. If we look 1 week prior, on July 10th, our total return was positive at 1.54%, but right now we are down 2.90%. So the portfolio went down by almost 4.5% over a week. But overall, it is still in a very healthy position. As we can see, the downside remaining for the portfolio moved by about 1.5%. Last week it was 53.97%, and right now it is at 52.5%. This is the percentage by which the portfolio needs to drop in order to trigger a margin call. The higher this is, the better. So despite a negative swing of over 4% in the portfolio's value, we are still in a very healthy position. And this has mainly been possible because in addition to high yielding positions like Biggie, HHIS, and the single stock ETFs, we also have defensive positions like C-Day, S-Day, and Utes. So if you look at the capital gain loss column, you will notice that tech-focused ETFs like Biggie and HHIS went down in the past week, while C-Day and S-Day went up. In other words, a mix of different sectors helps balance out the negative impact during a bearish market. And this is how I wish to keep it for my next set of purchases in this portfolio. I'm planning to focus exclusively on the following 5 ETFs for my future purchases: Biggie, HHIS, C-Day, S-Day, and Q-Day. Biggie and HHIS provide high income, while the Daymax ETFs provide a mix of growth and income. Based on my calculations, by using a 1.5x margin on these ETFs, I could very easily maintain the 40% yield on capital which I'm targeting for this margin account portfolio. Here is an example of how this would look. In this hypothetical scenario, I'm investing $10,000 in the margin account, but making purchases worth $15,000, buying these 5 ETFs. The amount allocated for each ETF is mentioned in the third column of the table we see on the screen, and based on this, these 5 ETFs would generate $335 on a monthly basis, which is an annual yield of 40% on the capital of $10,000. In my opinion, this is as close to perfection as we can get with our aim of securing a 40% yield. If you look at this portfolio, almost 40% is being allocated to C-Day and S-Day, which are defensive sector positions, while the remaining 60% is being allocated to HHIS, Biggie, and Q-Day, which are technology-focused positions. On the flip side, HHIS and Biggie are designed for generating high yield, whereas the Daymax ETFs are mostly growth-based with an overlay of 0 days to expiry option writing strategy for generating relatively high income. In other words, in this portfolio, we are receiving a combination of sector diversification, high yield, and also growth, all while maintaining a yield on capital of over 40%. If we go back to my actual portfolio, I have so far invested $11,000 in this account, and over the next 2 months, I'm planning to add another $9,000 to bring the total of capital invested to $20,000. My plan is to allocate the next $9,000 using the strategy outlined just now. Obviously, the one caveat with this approach is that the prices of these ETFs should remain roundabout to where they are right now. If the markets become really bullish over the next couple of months, then the prices might go up and the relative yield would go down, which means it would become quite difficult to maintain the 40% yield on capital. Although the probability of that happening seems quite low, given the crisis that's going on right now. So I'm hoping that the markets remain flat or maybe even go a little bearish over the next couple of months. Another weakness that you may have noticed in this plan is the ETF Biggie, whose price keeps falling while they keep paying out the same income. And there is a big question mark on whether they would eventually reduce their payouts. That is definitely a possibility. However, Evol does have a history of never cutting out their income payouts on any of their ETFs, and I believe they would like to keep that record intact even with this ETF. Recently, they also made some changes to the portfolio, bringing the total number of holdings to 23, which is more than double the number of holdings they started out with. Personally, I'm quite happy to see this change because it shows that the management is finally seeing the importance of sector diversification, which they lacked with their original holdings. So, based on all these changes, I do think the management is trying their best to maintain the current income payout levels. However, I am prepared for the worst case scenario. If that does happen, I could always just switch to high yielding single stock ETFs based on Shopify, Microsoft, and Meta. I think these three companies are very much undervalued because of the overall negative sentiment regarding tech companies in general. So these are my potential alternatives to the Biggie ETF if I feel like it is entering the territory where it might reduce its payouts. With that, we come to the end of this video. Let me know what you think about this new approach of sticking to just 5 ETFs. Don't forget to like, share, and subscribe if you found some value in this video. I will see you all in the next one.